In times when markets are shifting, it's critically important that you watch certain things to see, is the market going to be changing again? What we're going to do today, I got Price Rayner with me. We're going to be going through and talking to you about the 4 things we watched to give a tell of where the market's headed. All right, Price, so this is an interesting time. You know, to be perfectly frank, in times where the market makes shifts, it's really the opportunity to set your career in a trajectory that you don't have opportunities. If you're watching the market, if you're finding the opportunities, and you're being the resource with the information for your client. And let's just go through exactly what we watch, because a lot of people, and this is one of the reasons why, you know, as we watch, a lot of people are just watching what's closed. And that gives you a little bit of really a view in the back, you know, to 30, 45, even 90 days possibly of what happened back then, those closings do. Sure. So let's talk about why are we watching pending contracts?
Well, pending tells what's happening now and what's going to happen in the future. You know, we're kind of getting ahead of the game by watching pendings versus living in the past with closed sales.
And I would say this, that was why I would say for every agent to really concentrate on pending contracts, because in reality, because we're looking at a 30, 60, 90 day possibly, you know, backtrack when you're looking at solds, you're looking at a 30, 60, 90 day ahead view when you're looking at pending contracts. So it's going to give you the opportunity as an agent to really have information that is almost 6 months ahead of where the typical agent will be. This is great information that you can provide for your clients, to be the resource they're looking for. Now, in shifting markets, and to speak to that, let's start with days on market. What are we watching on days on market, and why are we watching that?
Well, we're watching to see if days on market on average are moving up and down, because that kind of is our barometer of demand.
Right, and when we're seeing that, let's talk about what we've seen this year, and you know what that looks like just in relation to what we've seen at other times.
Yeah, well, I mean, looking at days on market compared to the average for 2020, which was 141 days. So far this year, we have 90 days on market for the first 325 sales through the 15th of March. So we've seen days on market decrease a little bit over 36% year over year. And when we go back and begin to look at, you know, other days, which take it as the strongest part of the last cycle, which was 2005, you know, the lowest days on market got then was 106 days. So we're at 90 now, and it's March. Right. Historically speaking, we see more strengthening as we go into and through summer.
Right.
So we may see that move further to indicate more demand or stronger demand now than we had at the peak in the last cycle.
Yeah, so this is something to really watch, because what it's telling us is that sellers and buyers are agreeing on value.
Yes.
At a very high pace. It's a barometer, as you said, of demand. It tells us that there's a huge demand and that there's limited inventory. Now, here's the thing that we like to watch to see if there is a shift, because we're anticipating, obviously, an incredible year in 2021. What are we watching on days on market that could be a tell for something that may be changing or shifting?
Yeah, if we see days on market start to creep up, and you see that 3, 4, 5 months in a row, you know, that is another clue or tell that things are beginning to change, that we're not having buyers and sellers, you know, find a place to agree on a price. We're starting to see that deviate, so that'll indicate that another shift may be beginning to form.
Yeah, and I would say this is what you've done for years, and it's so helpful, is to have a historical perspective. And if there's agents out there and they don't know that, I mean, obviously we provide this for our agents, but if there are agents that are wondering how to do this, they can simply go into the MLS, look at the sales data for each year going back 20, 25 years the way we've done it for our agents, and see what those average days on market, see what that average price was, see what that average price per square foot, the number of transactions, and that's how we've put this spreadsheet together for our agents. Let's talk a little bit about, because obviously that's the telltale sign. Where we are right now, just every market we cover, we're basically in a place from Destin all the way to St. George Island where we're seeing record number of transactions and we're seeing record number of prices. Let's speak to why we watch the average sales price specifically.
Well, I mean, we're just looking for growth there to see, you know, that's another tell. When it starts to move rapidly up and begins to deviate from the mean, we begin to see some imbalance there, and we have to start asking questions to say, is this sustainable, and why is this type of deviation happening?
Yeah, and this brings up a good point. This is why that historical data is so good, and that, like you've been so great about providing, going back to 2000, where you've done the average mean line for our area, 5.4%. Because once you know that mean line, it gives you the idea that, okay, prices are going up. How far are we pulling away? A typical cycle, or anybody that's a statistician or an investor that's looking at a chart for a stock or whatever knows that there is a mean line, and you can only extend so far away from that mean line before it just begins to work its way back. Can you speak to where we are as far as on that mean line right now?
Sure. We are 38.68% away from the mean line. The mean line, which could be 1,301,000 if you take that 5.46% and run that out, and our average price right now is 1,000,008. So 1,804, 1,804. So we're about 39%, away from that line. So that's significant.
Yeah, and I would say this: no matter which market you're in, finding that mean line is so critically important, because it tells you where we are in the cycle. So let's talk a little bit about that. Where were we at the highest point during the last boom? How far were we away from that mean line? Because this is now where you can really start historically begin to see, okay, where are we? Do we still have room to grow? Or what should we be watching out for?
Yes, well, what I've looked at there is I've taken it back to 2004, because I think 2004 is a very good barometer for where we are now, because that was the year in which the number of sales moved up quickest and average price moved up quickest.
Right.
And at that point, the deviation was 69.13%. We were so we saw a very substantial deviation from the mean line at that point. It continued to extend further into 2005 and 2006, that deviation, but we began to see sales slow there.
Right.
So we're not at that point yet, or we're maybe approaching that point. So I don't have really good data to compare to 2005 and 6 with information that is real time in this cycle.
Yeah, but here's the great thing about that is this is almost a tell to be watching, because what we saw in history doesn't always repeat itself exactly, but it's a great way to have an outline or some bumpers on what to expect. What we saw in 2004 and what we're seeing right now, just to be perfectly frank, is we're seeing the increasing number of transactions and increasing average sales price. So they're both moving, which tells us that buyers and sellers are in conjunction. 2005, what we saw was we began to see the number of transactions level off and then begin to pull back. Meanwhile, prices began to continue to go up. Can you speak to what that was, what it really was?
Yeah, well, it was just sellers not willing to come to where buyers wanted to be at that point in time, and that created that deviation. Created a softness in the market and was the beginning of the correction. And that it's just as simple as that, Jimmy. We can go in and make it as complicated as we want, but they weren't coming together, and so it just had to begin to soften at that point, and that's what we saw there.
And it's speaking to the demand. There was still enough demand that there were a few people that were willing to pay those prices.
Yes.
But the number of transactions, we began to see less people, which was the tell of what was to come.
Yeah, and then that continued into 2006. We still had rising prices, and then there was less sales in 2006 because sellers had not come to that place of becoming willing to meet buyers where they wanted to be.
Right, and then all of a sudden you have sellers, you have the increasing days on market. Sellers begin to say, have I missed this thing? They begin to reduce prices. Buyers, they still have to find where that level is that buyers are willing to, and that's where you find the market. So the pullback, back then was it was catastrophic because of so many other things that's not this market now.
Right, that's right.
But the factor simply was the buyers and sellers were not agreeing, and the sellers began to try to retreat to where buyers were. They simply weren't there. That's kind of what we saw in the past. Now let's talk about, we've talked about the days on market, we've talked about the average price. What are some other things that we're watching?
Well, we want to watch the total number of transactions. That's very important to watch. And in addition to that, we look at the price per square foot.
Right. Yeah, and that price per square foot really, because what can happen is depending on the breadth of the market, the number of transactions, a few sales can really skew your average price, but it doesn't typically lie on your average price per square foot. So what are we watching? Same thing on the price per square foot?
Yeah, that's exactly right. We just watch it move up, and then we can take the price per square foot and kind of divide that into our average price, and that will give us roughly the average size of a home. So we begin to watch that. Just a clue in that sometimes when we begin to see that people are paying. So sometimes demand may not be readily observable in average price or price per square foot alone, but when we do that math, we can begin to see that people are paying more for a smaller home. And that may be a big clue for us. It's kind of buried in that data that sometimes we have to look at, particularly when we're at this point of the cycle where a buyer and seller come together. It's moving so fast. That may be another clue for us going forward as to the direction the market's trying to move.
Yeah, absolutely. So let me wrap this up, just basically saying this. If you're in the real estate business, this is the reaping time.
Yes.
There is opportunity in abundance. If you're watching to see what's shifting, if you want to be the best resource, be the best source of information for your clients. What does that mean? If you've got people that you sold houses to in the past, now is a great time for you to be reaching out, talking to them about what's going on in the market, asking them what their plans are for the house, being the resource, beginning to build that database of people that are looking to potentially make a move in the next few years. Add the value. I promise you're going to get the opportunity in the at-bat when it comes time for them to sell their house. Now more than ever, people need that information more than they ever have. So this is an opportunity to really add value in a way. Watch your days on market. Watch your average price. Watch your average price per square foot and watch those number of transactions. If you'll do that, I promise you're going to be at a place where you're going to be able to tell and see some of the things before they actually come to fruition. Take care and we'll talk to you soon. Thanks for watching the video. I specifically chose the video below for you because it builds on the one you just watched. I hope it's helpful, and I'll talk to you soon.